The slow transition away from the mining boom, low inflation, weak employment and a stubbornly high dollar have all played a role in the RBA's decision-making. Confidence has also been weak, though there is hope that a friendlier federal budget may provide some respite. At record low rates, the impact on savers has been well documented, as has their response. We've seen many take on more risk by supplementing income needs with dividend payment stocks. It's been a good strategy for the last few years, but the market is no longer cheap, and some dividend payments may be close to plateauing. Well, what's unusual about the market is that high dividend paying stocks, like the banks, have typically rallied when rates have been cut, but that hasn't been the case this time. While there has been broader volatility in the market, it's actually the banks that have been one of the hardest hit sectors. We think a primary reason for this is that lower rates have found their way into the property market and that this is now getting close scrutiny from the regulators. For example, we have recently seen some very strong statements from both ASIC and APRA. ASIC has been quite forthright of warning a property bubble, noting the long-term income to price ratio is currently at historical highs. With rates so low, people and property investors in particular are gearing up. As we know, high prices and excessive gearing can ultimately become a very messy cocktail. And while ASIC has property speculators and some self-managed super funds in their sight, APRA has been focusing on the lending standings of our major banks. That general feeling is that the banks may soon be told to hold more capital. One clear implication is that this could place future dividends and their growth at risk. For investors, the stellar run in bank dividends over the past 5 years may now be coming to an end. Combined with a so-so reporting season, this is why bank shares have been weaker in recent times. We have been a little concerned about valuations, so the recent pullback was perhaps overdue. There have also been some abrupt moves in the bond market of late, and we remain cautious for the time being. For investors, it remains sensible to keep risk management front of mind. Low interest rates and a more expensive market provide a testing backdrop for investors who need income, but find the share market perhaps a little too volatile. A well-diversified portfolio always remains a good starting point to mitigate some risk, but for those who remain cautious on equity markets, investing in a low volatility equity fund is another way of gaining exposure to shares without riding the highs and lows of market sentiment. A share portfolio that is able to utilise exchange-traded options can be managed to generate attractive levels of income at lower levels of volatility than the overall market.